So the current money system and the current money that we use digitally can actually be labeled as, I would say, digitalized. So in English language, there is a nice difference between digitalized and digitized. Digitalized basically means that you use technology for manual processes to make them faster, to make them more efficient. However, digitization means actually converting something into a digital format. So represent that something by bits and bytes. And this is something that is happening currently also with money. So when we look back, already in ancient times, there was book money. So money in ledgers of banks or other institutions that had the function of banks. And in fact, anthropologists say that the first written letters were actually records of debts and claims and accounts. So basically, the technique has not changed over time. The technique of how money is moved. The only thing that has changed is how the payments can be transmitted and how technology is used for updating the ledgers. So let's look into how our current money system works. Actually, what we have is a public-private partnership, a PPP. It's a two-tiered monetary system between central banks and commercial banks. And counterintuitive, and many people still don't understand that in very detailed way, is that commercial bank money is the major form of money. So there's many misconceptions still prevalent about the role of banks in the economy. But currently, banks, so commercial banks, play an extremely important role in the economy as they create the majority of means of payment and store of value. And they do this whenever they grant a loan or buy certain assets. So commercial bank money is always a liability of the issuing commercial bank. And given that it is a liability, the asset side is very important. And I will come back to this asset side in the upcoming slides as well. So every bank basically creates its own money. And you can think of many different private money ecosystem around banks already today. And fungibility between these different commercial banking areas is basically created by settlement in central bank reserves, so central bank money. So payments can actually be settled on a gross or a net basis. And there's a drive into gross settlements due to a shift to instant payments, which is shown in the graphic that you also see on the slide. So every transaction from a bank account to another bank account at a different bank, which is the liability side of the bank's balance sheet, is settled in central bank reserves. And all ledgers must be kept updated, and intermediaries are included in the transaction. And these are basically the underlying mechanisms for account-based money, right? So we have different account-based monies in each of the ledgers of the banks. They're transmitted by using central bank money. But the new technology now enables token-based digital money that can be transferred peer-to-peer. So bank deposits could therefore, in theory, potentially be transferred without the need for settlement in central bank reserves, because they can be transferred directly from one bank to another and from one account to another. However, this might lead to some problems, and we will look into this later again, how commercial banks can actually overcome these problems. But first, let's look into what truly digital money is. So I already mentioned that new technologies allows money to be represented by bits and bytes directly, and not only to use technology for the transfer of funds in accounts. So think of, for example, cash payments, physical cash payments, where only the sender and the recipient is involved. New technology basically also enables this feature with digital or digitized money that is represented by bits and bytes that can be sent seamlessly directly between the parties that are involved. There are many advantages that are expected to be realized by using a digitized form of money. And the main idea is that you have a token that represents this money, which can be transferred directly between the existing nodes on a distributed network. The transfer of token always means settlement of the token. This is one of the key aspects of tokenized money. So every time this token is transferred, it also settles the transaction. This brings about several advantages, like the ones that you see on the left side on the slide, like cost reduction, because in peer-to-peer transmission, the elimination of intermediaries saves a lot of cost. You have also increased settlement efficiency because of the elimination of manual processes in this process, and because you don't need so many intermediaries anymore. You have a lot of automation efficiency gains. So these transactions can be executed and programmed. So smart contracts that can be used on distributed computing systems allow transactions to be tied to conditions that must be met for the transaction to be executed automatically. So this brings about a lot of automation potential. And also in the capital markets, for example, a lot of processes around life cycle events can be automated. We also see great advantages for pay-per-use mechanisms, because sensors on certain machines can actually measure the usage and then send this data into smart contracts that actually trigger payments automatically. Machine-to-machine payments is a very big topic, and in the future, the Internet of Things will become very important. So devices are given a chip and a wallet that can then also transact or place transactions and do payments between each other and between machines. And last but not least, the whole topic of delivery versus payment, especially in the financial sector, where the settlement of the trading processes in the financial system can be highly automated and digitized, especially also in combination with the tokenized assets. And smart contracts can be enabled or can enable a lot of efficiency in these processes. So which institutions can actually create a token that settles when it is transferred? And that is basically the main question that I want to raise today. So let's look at the existing debate around the digital euro. So there's a lot of fuss about CBDCs. So will CBDCs provide a solution here? Central bank money currently exists in two forms: physical cash and a token for retail payments, and central bank reserves that can be transferred digitally for interbank payments. As central banks have the monopoly over central bank money creation in the currency area, transfers of the central bank money always settles. So this is because the central bank is the most solvent debtor there is. It cannot go bankrupt, is backed by millions of taxpayers, and provides legal tender. So central bank digital currency could be the solution for the need of a token that can be transferred digitally between peers. Now let's look into these CBDCs, the central bank digital currencies. So there are two different types of CBDC, wholesale and retail CBDC. Wholesale CBDC is a digitized version of already existing central bank reserves. It can be used for settlement of digital assets and bring about many advantages for more efficient interbank payments, programmable transactions, and more efficient cross-border payments, and overcome also the T+2 settlement time, for example, stocks, which currently locks a lot of liquidity and increases interbank risks. However, so far, no central bank has indicated that it really wants to develop a wholesale CBDC in the near future. So private initiatives, for example, Finality, want to provide a synthetic version of CBDC by tokenizing reserves held at special accounts at the central bank. So just recently, the Bank of England has issued a press release that it now wants to offer omnibus accounts in their RTGS system that are the prerequisites for synthetic CBDCs. So wholesale CBDCs or synthetic CBDCs for interbank payments are a great way to realize the efficiency gains in the capital markets. But what about the retail use cases that I want to focus on today? So central banks also think about offering a retail CBDC. Actually, this is the main motivation of the more than 86% of the global central banks that look into CBDCs. However, the designs of retail CBDCs are far from being clear. So only a few projects have started already, especially developed countries, just started to look into potential technical designs and use cases for a CBDC. It remains unclear if a retail CBDC will be DLT-based, will be able to be used for programmable transactions that also involve smart contracts and which can be used for industrial use cases in the B2B sphere. Most importantly, statements of central banks counteract these use cases, as they state that they don't want to harm commercial banks. So if retail CBDCs was used for all of these use cases that I previously showed, it would become a far better money than current bank deposits, which might drive out banks from being the main creator and manager of money and payments. So some economists therefore say that retail CBDC will mimic cash in the sense that only simple transactions between individuals and business will be possible. So C2C space and maybe B2C space. And some newspaper articles over the last days seem to confirm this. But finally, we can only say it remains really unclear for which use cases a retail CBDC will be able to be used. But I mean, not only the central bank works on tokenized money, also the private sector. And now let's look into how stablecoins try to solve this issue and if they are able to provide a scalable solution for the digital euro. So stablecoins is a big topic, obviously. There are coins that are backed by certain assets that give the coin a stable value against a reference asset, for example, money. They also aim to settle transactions when the token is transferred peer-to-peer. There's been enormous increase of stablecoins in the last year, partially also due to strong demands for the decentralized finance ecosystem. And in Europe, stablecoins will be strongly regulated by the MiCA regulation. So stablecoins will fall under the e-money directive, which requires backing the tokens by high-quality liquid assets or bank deposits. So if stablecoins become successful and provide a type of money that is used strongly, this might lead to some problems. For example, stablecoins will become gigantic collateral silos that absorb enormous amounts of high-quality liquid assets that are currently used, for example, for monetary policy reasons. A run on government bonds markets, either due to a fast success of a stablecoin or runs due to the loss of trust, could lead to price volatility and liquidity spikes in these markets. Since short-term rates are closely linked to credit to the real economy, this might lead to negative effects in the real economy and also the mechanisms of monetary policy. So the ECB estimates that a global stablecoin like Diem could absorb actually $3 trillion in government bonds. So we're talking about enormous sums, even if only a part of that sum will be used. So the part of money that is held in bank deposits or money market mutual fund shares that can also be used for backing these stablecoins might be prone to liquidity, market, credit risk of the bank or the money market mutual fund as well, which is not secured by deposit insurance schemes and other regulatory approaches that banks have. If the bank runs into difficulties, these funds might be in trouble, actually. And furthermore, financial risk could emerge when there are runs on stablecoins, which might lead to liquidity crises because the bank of the money market mutual fund might not be liquid enough to pay out the users of the stablecoins. Additionally, shadow bank money is created, which cannot directly be influenced by monetary policy instruments of the central bank. And therefore, the power of monetary policy of central banks is decreased. And last but not least, e-money might lead to siloed solution. Think of, for example, PayPal. Banks don't accept PayPal tokens as a means of payments. Users have to go to PayPal, redeem their PayPal tokens, and transfer the money to those who don't accept the PayPal. Also, it cannot be used for B2B payments easily, as the account need to be separated from the other accounts the business holds. Holders of the token somewhat become customers of the issuers of the token, as they hold a liability of the issuing company, which might limit the usage of these tokens as a scalable solution for the digital euro. And the effect of banks will be that many deposits will flow out of the banks that lose their customers into the bank that cooperates with the stablecoin provider. And this bank will become very large, which will have to allocate the money that it receives into assets. So there seem to be some problems with stablecoins as well, especially due to the hard regulation in Europe. And it remains unclear if stablecoins will provide a scalable solution for the digital euro that we need. So we've seen that banks actually create the majority of money by granting loans. So why don't banks find solutions for tokenizing this money that they create? So let's finally look further into how commercial banks can provide a retail-based digital euro. And we've now elaborated that the key advantage of tokenized money is that transfer of. And we've also seen that commercial bank money is a liability of the issuing bank that is backed by rather illiquid assets such as credit claims or other financial products. Whenever these liabilities are transferred, a settlement asset, central bank reserves, is used to update the accounts. So if central bank money is not used or needed anymore, you would end up actually having many commercial bank money tokens that are backed by assets of very different quality, which pose difficulties of tokenizing commercial bank money. Some say the era of free banking will re-emerge with the negative downside of different values of different private monies. However, we believe that there are some ways to overcome these difficulties that we are discussing with our clients. So for example, banks could create a, let's say, super bank or a DM of European banks, which issues tokenized money that is backed by assets of all the participating commercial banks. Banks could also back their money tokens by high quality liquid assets in some segregated accounts. However, banks could also enhance interbank credit lines and include the settlement risk into their books when clients send their money, and then settle these interbank credit lines at some later stage. But also, looking at how the current payment system works, you could think of multilateral clearing schemes that could evolve that on DLT actually, and solve the problem of all the multilateral credit lines that exist there. There could also be APIs that connect the DLT ecosystem with the existing payment system to leverage upon, for example, instant payment schemes that could be used today. And also in the future, intra-chain bridges between the retail and the wholesale ledger could lead to very efficient clearing in wholesale CBDC. So you see that the existing commercial bank money for DLT payments might not be most sexy way of bringing up a digitized form of money. However, it should be in the interest of basically all participating institutions in the financial sector that also a digitized retail money is based on commercial bank money and not on e-money or potentially CBDC. And we're happy to explore this journey with you and help you to understand how your bank can actually make use of DLT for retail payments. And that was basically my content for today. But what I also want to highlight is that we've written a short article on our website about this topic in German. Make sure to check this out. And last but not least, I also want to include some slides that show how EY can help financial institutions in the DLT space. So we developed end-to-end solutions around DLT for consulting strategy, business requirements, for example, also target operating models, but also tax is very important, obviously. Our legal team helps for KYC, AML questions. So we have quite a lot of competency built up over the last years. And we're happy to help you in your, for example, also STO projects and so forth. What makes EY, I think, rather special is that we have our own blockchain tools. And it was just announced that we spent another $100 million on the development of these blockchain tools. So, for example, EY Ops Chain is already being used in the real economy for different real-world use cases. For example, Peroni, an Italian beer brewery that mints NFTs that batch basically, or that track the batches of beer bottles on Ethereum. The blockchain analyzer helps you to understand on-chain transaction and visualize them and find fraud in them. We have a text calculator, and especially also we have a smart contract and token review tool that is very well received in the market, that you can use before launching your token or your smart contract on chain. Feel free to reach out anytime if you're interested in any of these solutions. Last but not least, make sure to check out our EY Global Blockchain Summit that took place actually 2 weeks ago. We also have frequent podcasts on this interesting topic as well. And we were 3 colleagues here talking to you Monday, Tuesday, and today. And make sure to check out the recordings of these talks as well in when they are released. So thank you for your patience and for your interest in this talk, and have fun with the rest of the conference.
Thank you very much, Manuel Klein from EY. If you have a second to answer one question very briefly. We had lots of questions, but there's time for one.
Sure, yeah.
Great. But very briefly, because it's two-part questions. How far are we from the adoption of the digital euro? And do you see different rates of adoption across different European countries?
Well, that's a very good question. I think we still have to talk more to the industry to really understand if there is already a need for a digital euro or a digitized euro, or if certain use cases of blockchain technology or certain parts of use cases can be enabled by blockchain technology, not talking about a fully on-chain token that represents money. So when we speak to some industrial clients, they say, well, blockchain has so many advantages, and one of them is actually one immutable ledger. And if we already have that, we can build up a lot of use cases around this. And then sometime maybe also include payments in electronic money or in DLT-based money. So I think we still have to look back into the use cases and see where we find them in the real economy. In the financial markets, I think it's quite clear that there are some very good use cases. And I think we will see a lot of adoption, especially when, for example, also private institutions like Finality will be able to issue a synthetic CBDC in the whole.
Great. Thank you very much, Manuel Klein.